Hello and welcome to our recap of IAS 1. Remember, IAS 1 tells us about the presentation of our financial statements. So IAS 1 tells us what we need to include in our financial statements. We need to have a statement of financial position, and we need to have either a statement of comprehensive income plus a separate income statement and comprehensive income. So we either show them all together or we have a separate income statement and comprehensive income. We'll talk about that in a second. We also have to have a statement of changes in equity, and we have to have a statement of cash flows. Lastly, we need to have notes and policies to detail how we have prepared the financial statements. So for our statement of financial position, there was a pro forma in the workbook that we looked at. We had to split up our assets and liabilities into current and non-current liabilities. Remember, current liabilities or assets were ones that we would think would be settled within 12 months. So if they were settled within 12 months as part of our normal operating cycle, we would classify them as current. The rest would be non-current. Also, we had other components of equity. So we had our reserves and we had other components of equity. These would be things like general reserves and revaluation reserves. So we had revaluation reserves if we revalued an asset, for example, or general reserves for movements on things like financial assets. We also looked at our statement of changes in equity. We had a pro forma in the workbook, and this was just a summary of all of the changes in equity. So how has our share capital changed? How has our share premium changed? What effect has that had in the year? So for example, there may have been share issues in the year, dividends paid in the year. Those would affect our equity balances. This is just a summary or a reconciliation of those changes. When we looked at comprehensive income, remember again there's a pro forma in there. We said that the total of comprehensive income would be the profit or loss in the period plus other comprehensive income. So remember, this other comprehensive income was not shown in the profit or loss and was things like the revaluation of a non-current asset or movements in financial instruments. So again, that's not in the profit and loss, it's movements in reserves that are shown through other comprehensive income. So IAS 1 gives us a choice. We can either show all of this in one statement. So we have at the top of it our income statement and then at the bottom other comprehensive income. Or we can have separate statements, an income statement and a separate statement of comprehensive income showing those movements in our equity reserves. Remember that for not-for-profit entities, there may be separate areas that they will be interested in. So they'll have different aims. For example, a profit-making entity will be interested in increasing shareholder wealth, and the directors will be acting on behalf of the shareholders. So they'll be interested in getting finance to fund that business. For a not-for-profit entity, well, they want to achieve value for money. The managers are the agents of the public who are providing that money, and they will be financed through donations. So the focus of them will be slightly different. So therefore, the financial statements need to provide slightly different information. So accounting standards, when we're looking at them, not all of them will be relevant to not-for-profit organisations. So they'll maybe want to measure things like inventory and non-current assets, but the performance areas will not be as applicable. So for example, earnings per share wouldn't be applicable to not-for-profit organisations. So we need to be aware that there are different aims for different organisations. In profit-making entities, they will be interested in all of the standards. Not-for-profit organisations, the measurement ones will be more applicable, the performance ones not so applicable. So IAS 1 covers our presentation of financial statements.